This is Macro Horizons, episode 357, January Drift, presented by BMO Capital Markets. I'm your host, Ian Lyngen, here with Ben Jeffery to bring you our thoughts from the trading desk for the upcoming week of January 20th. And as we look forward to the three-day weekend, we were tempted to thank SIFMA. That is, until we realized that there are only 2 additional full market holidays before Memorial Day. Thanks again, SIFMA. Each week, we offer an updated view on the U.S. rates market and a bad joke or two. But more importantly, the show is centered on responding directly to questions submitted by listeners and clients. We also end each show with our musings on the week ahead. Please feel free to reach out on Bloomberg or email me at ian.lyngen@bmo.com with questions for future episodes. We value your input and hope to keep the show as interactive as possible. So that being said, let's get started. In the week just past, the Treasury market managed to hold a remarkably narrow range, particularly in the 10-year sector. In the 10-year sector, the spread between the Bollinger Band upper and lower parameters was just 8.3 basis points. For context, the last time the Bollinger Band was so low was in January 2021, and it was followed by a spike in 10-year yields of 26 basis points spread over several trading sessions once the range finally broke. In fact, each of the last 5 times in which the spread between the upper and lower Bollinger Bands was below 10 basis points, the Treasury market resolved to higher yields. So we continue to view the current formation in U.S. rates as eventually leading towards higher yields. Now, this doesn't mean that we're going to get 10-year yields back to 4.50, but a retest of the 200-day moving average at 4.23% should be on the table as a potential outcome. All that being said, there is, without question, an array of cross-currents that have combined to leave the Treasury market effectively unchanged, with 10-year yields effectively bound to a range of 4.1 to 4.2 for the foreseeable future. The week just past did include the CPI report for the month of December. The highlights include the fact that core CPI came in below the market expectations. The consensus was 0.3%, and the official number printed at 0.2. However, on an unrounded basis, core CPI increased 0.239%, so a high 0.2, but nonetheless a 0.2. We also saw a modest gain in the supercore measure of 0.29. Recall that supercore is defined as core services excluding OER and rent. And, as has been the case recently, there was no evidence of tariff pass-through, certainly none of any relevance, as we saw core goods at 0.0, which is the lowest since May. We did see an increase in airfares of 5.2% and an increase in hotels at 3.5%. But overall, there was nothing contained within the inflation report that materially altered the market's expectations for the Fed. We continue to expect that the Fed will pause in January and revisit the topic of resuming the process of normalization at the March meeting, keeping in mind that there will be a lot of economic data between now and March 18th. The Treasury market also grappled with the news that the Department of Justice has subpoenaed the Fed over Powell's testimony regarding renovations at the Fed's key buildings. In response, Powell issued a video message which effectively said that the criminal investigation is politically motivated and a result of the well-publicized disagreement between the White House and the Fed in terms of where to set policy rates. If anything, we expect that this development will galvanize the hawks on the committee and only serves to reinforce our January pause expectations.
So this week we got the second marquee piece of macro information that if there was any chance of a change of heart from investors' perspective around what's going to come from the Fed at the end of this month, it was put to rest because a benign CPI print for December with a downside surprise, with core consumer price growth at just 0.2% month over month versus the 0.3 consensus, has given some credence to the Fed's recent rhetoric that their primary concern is still centered around the health of the labor market and the trajectory of hiring, and while core inflation is not at 2% and will likely not be at 2% for some time, the trajectory is good enough to keep the easing bias intact, and even if the next rate cut isn't going to come at the end of January, the bias on the Powell Fed, and whichever Fed comes after, is still going to be moving policy rates lower. Now, what is this translated to in terms of the Treasury market and the price action we've seen? It's a further cementing of the 4 to 4.2 trading range that has now persisted for what is increasingly feeling like forever, and we continue to see the low volatility environment persist. This despite geopolitical rumblings in the Middle East around what's happening in Iran, and obviously the follow-through of what took place in Venezuela a few weeks ago. Still, we have 10-year yields at 4.15 more or less, and the debate continues on if we'll see 4.25 or 3.95 first.
And let's face it, when we think about the length of time that 10-year yields have spent between 4.10 and 4.20, it is forever in bond years. Taking a step back, the reality is that over the course of the next several weeks, we will get some meaningful inputs, perhaps not from the data, but at least from the FOMC, the decision to pause, and what it implies for forward policy expectations will be very front and center on the 28th of January. But until then, the market will continue to digest the implications from the Department of Justice's subpoenas of the Fed for information regarding Powell's congressional testimony on the Fed renovations. Now, we're on board with Powell's interpretation that this is less about the renovations and primarily about the disagreement between the White House and the FOMC on where and perhaps how policy rates should be set. But as you point out, Ben, the economic data continues to drive the Fed's decision-making, and the data that we have seen since the last meeting suggests that a pause is warranted. For the market's part, futures continue to price in more than 50 basis points worth of rate cuts in 2026. However, as the data and the Fed messaging continues to evolve, those rate cut expectations have been pushed further and further into the second half. At present, the March meeting is pricing in just a 25% chance of a quarter-point cut. Frankly, there's a lot of data between now and March 18th, and those odds seem fair, all things considered.
And in the aftermath of the headlines that the Fed had been subpoenaed regarding the renovations and the potential budget overruns on the construction of the Fed building in D.C., the follow-through from a political perspective was interesting. We saw a few GOP senators come out and explicitly say that they would block any Fed chair nominee from Trump until there was greater clarity and accountability on what exactly the DOJ was pursuing in terms of its investigation of Powell. A congressional defense of Fed independence introduces an interesting reaction function and, based off what we heard from the chair, a potential stubbornness dynamic in terms of a re-emphasis on setting monetary policy based off the performance of the real economy and not as a function of pressure from the executive branch. But to see the Trump versus Powell argument, for lack of a better word, spill over into having implications for Congress, it's interesting to see that the president's adventures in monetary policy have reached a point where there's starting to be some official pushback. Now, if we've learned anything about the current administration, it's that both Trump and Bessent are not afraid to use creative solutions to reach their ultimate economic aims, whether that's related to the Supreme Court's ruling on tariffs or a way to get long-end yields and mortgage rates lower, even if the Senate throws a wrench into whatever ultimately comes to pass from a federal justice perspective at the Fed. Both the Treasury Department and the White House are still very intent on bringing 10-year yields and home borrowing costs lower. So while yes, from a purely economic and macro perspective, we still think that the path of least resistance for the shape of the yield curve is steeper, a meaningful headwind to that thesis might be the fact that Bessent and Trump want it flatter.
We also need to layer in considerations on the geopolitical front. Now, one could be excused for looking at the escalation of the tensions in Iran as a potential flight to quality trigger. At the end of the day, the Treasury market appears to be trading it primarily through the lens of a reflationary impulse. In the event that the U.S. ultimately does intervene, whether it's through strikes or other military actions, one should expect upward pressure on oil prices, if for no other reason than a potential naval blockade of the Strait of Hormuz. At the end of the day, we still consider higher energy prices to be a tax on consumption, and while it might contribute to lingering reflationary angst associated with the trade war, the true impact will probably be short-lived, and if there is in fact a true regime change, that could bring more Iranian oil back into the sanction-free global market.
And it wasn't just CPI, DOJ, or geopolitical headlines that defined trading in treasuries this week, as we did get a supply doubleheader on Monday with 3s and 10s, followed by Tuesday's bond auction. Unsurprisingly, and as has been thematic throughout the course of, frankly, recent memory, all 3 auctions were well received, with notably 10s and 30s stopping through, despite the fact that from a longer-term perspective, yields are nothing, if not mid-range, and on an intraday basis, both auctions came relatively near the yield lows of the day. Now, it's by no means our base case that the upcoming refunding announcement in February is going to deliver any major surprises in terms of the path of Treasury issuance. Maybe we get more questioning around further increases to the buyback program, but there is an idea that we're increasingly hearing offered in that, perhaps, and in keeping with Bessent and Trump's desire to get yields lower, maybe we will see a more aggressive approach in terms of controlling the issuance profile of Treasuries in order to massage the market to a place that the administration is more comfortable with. Specifically, we've heard the potential for decreases in 20-year auction sizes, or even an outright cancellation of 20s, or something along the lines of an earlier increase to 2s and 3s than was initially laid out in November's refunding language, that would come at the expense of 10, 20, and 30-year auction sizes. So boosts to 2s and 3s and cuts to 10s, 20s, and 30s, which obviously would have a shortening influence on the WAM of the overall market and drive a supply-driven flattening of the curve. Now, is that why we saw 2 stop-throughs at 10s and 30s this week? No, not specifically, but as an indication of how quickly sentiment has shifted from bond vigilante bearishness and questions about who was going to buy all this treasury supply to the outlook around long-end supply actually becoming more bullish for longer-dated bonds. It's impressive how Bessent and the Office of Debt Management have been able to shift the narrative in favor of a far more constructive supply backdrop for treasuries.
It's also notable that some of the key bond bearish risks that defined trading in 2025 failed to materialize. There were concerns that treasuries would lose sponsorship from overseas participants. That clearly has not come to fruition. There were also concerns that treasuries would lose their status as a safe haven or flight to quality instrument, and as we've seen on several occasions, treasuries still hold that position in the market. Adding to last year's angst was the notion that tariffs would push realized inflation back to a higher plateau comparable to what was seen in 2022 and 2023, and as the December CPI print reiterated, that also was not the case. All of this occurred with the backdrop of what was expected to be a widening federal deficit. Notably, at last measure, the federal deficit was just 5.3%. A far cry from the concerns that we would be faced with a 6.5% or 7% federal deficit. Taking this all in aggregate, it's very consistent with our expectations for there to be ongoing support in the Treasury market and for longer-dated yields to drift lower as 2026 unfolds. The one caveat is in the near term, the next several weeks or even couple months, there's a strong seasonal bias towards higher yields in the Treasury market that we expect will come into play this year as well, so it wouldn't be surprising to see the eventual breakout in 10-year yields from the 410 to 420 range err on the higher side and provide a buying opportunity for sidelined investors.
So it's 425, not 395.
For a little while.
Is that transitory?
Well, that's a bit of a conundrum.
Yeah, it's really like driving, looking in the rearview mirror.
How else would you drive? In the week ahead, the Treasury market will have Monday off, so we have that going for us. On the data front, there's really not a great deal on the calendar that we expect to materially influence the macro narrative. Instead, we anticipate an ongoing debate regarding central banking independence, although the Fed will be in its period of pre-meeting radio silence. There have been rumblings out of the White House that Trump is readying to announce his nomination to replace Powell sometime in the last 2 weeks of January. At this stage, the field of potential candidates has been narrowed far enough that we'd be surprised if there was a particularly sharp response in the Treasury market to Trump's final decision. That being said, it will be topical, and headlines should drive some type of price action. As a theme, we maintain that the more of a Trump loyalist that the incoming Fed chair is perceived to be, the more of a steepener that will create in the Treasury market. Now, it goes without saying that an especially dovish Fed chair should push 2-year yields lower, but it doesn't mean that the steepener will be a wholesale bull steepener. In fact, if the nomination leads to concerns about the Fed's commitment to fighting inflation, it follows intuitively that break-evens should widen and nominal rates should move higher, within the range, of course. As we look out to the week ahead, geopolitical tensions are likely to remain a background factor, and while we don't see anything that would obviously break the range, we will note that the core PCE figures for October and November will be published on Thursday, and we're anticipating confirmation of the benign inflationary environment that appears to have been the case during the government shutdown. On the supply front, there's a $13 billion 20-year auction on Wednesday, as well as a $21 billion 10-year TIPS auction on Thursday. As has been the case recently, in weeks with relatively limited macro data in the U.S., we expect that the moves overseas, particularly in JGBs, Boons, EGBs, and Gilts, will have an outsized influence on the overall direction of U.S. rates, of course, within the range. As we've noted, 10-year yields continue to hold a remarkably tight range, and while we are biased for any breakout of that range to be towards higher rates, the reality is that the range cannot persist indefinitely, and once it is breached, it's safe to say that we'll see investors more willing to position for the year ahead. We've reached the point in this week's episode where we'd like to offer our sincere thanks and condolences to anyone who has managed to make it this far. And as the ever-narrowing range continues to define trading in U.S. rates, we're reminded that vol is always darkest before the spike. Thanks for listening to Macro Horizons. Please visit us at bmocm.com/Macro Horizons. As we aspire to keep our strategy effort as interactive as possible, we'd love to hear what you thought of today's episode. So please email me directly with any feedback at ian.lyngen@bmo.com. You can listen to this show and subscribe on Apple Podcasts or your favorite podcast provider. This show and resources are supported by our team here at BMO, including the FIC Macro Strategy Group and BMO's marketing team. This show has been produced and edited by Puddle Creative.
The views expressed here are those of the participants and not those of BMO Capital Markets, its affiliates, or subsidiaries. For full legal disclosure, visit bmocm.com/macrohorizons/legal.